Hi, it's Dre Griggs of Obsidian Wisdom. Today we discuss how to shield your retirement savings from inflation. Today I'll share 5 tips with you on how to shield your wealth from rising costs. When it comes to understanding the importance of shielding your retirement savings from inflation, you have to look no further than the value of your money, the money that you worked hard for over the years. Inflation is a very fancy way of saying that your money does not purchase as much stuff anymore. If you don't adjust your lifestyle in any way, the cost of that lifestyle goes up over time. And when you really think about it, and we've been discussing inflation a lot because whether you're talking about COVID or you're talking about tariffs, there's always a discussion on what the impact on us as we plan to retire is. And one of the difficulties that anyone that is planning to retire has is, unlike people who are still in the workforce, as inflation comes, sometimes you're able to increase how much you make in the workforce. Sometimes you're able to find a new job at a new higher wage. Once you're retired, the only thing that you can do to ensure that you're able to maintain your lifestyle as the cost of that lifestyle goes up is to ensure that you have already invested your assets in a way that shields it from inflation. And these are normally going to be ways that I can invest my money that goes up with inflation. Before we go into the 5 tips to shield your retirement savings from inflation, let's start with what inflation really is. And to do that, I'm going to share my screen with you and we'll go over high level what causes inflation. Of the probably 10 causes of inflation that we could discuss, there's always the same event happening. And in any economy, there's really 2 interactions, and that interaction is always going to be a business, right? So this is my business. And then it's going to be the individual, right? So this is me and you. Every time we interact in the economy, there's always going to be a relationship between us and a business and us, the individual and the business. And then we interact in 2 places. So these are going to be markets when you think of it. So we always interact in the market, and this is always going to be our relationship. And when you have this understanding of the markets and how we interact, it makes it easier to understand what can and does cause inflation. And so when you look at us, if we're going to go to the market and we're going to buy something, so we will spend money. And then the market is going to give us back stuff. So whatever we went to the market to buy. Well, where did we get that money? We got that money by trading our time in the market. So we trade our time. We go to the market and we do stuff, whatever is needed, whatever the profession and the job that we have is. And then the market gives us what? It gives us the money. So we go to the market, we work, we provide some sort of a service. And then at some point in time, we're given money for the service we provide. We then take that money and we go spend it in the market on the stuff that we want. So that's half of the economic cycle that we're all going to be experiencing. Well, who is the one that gives us the money from the market? That is going to be the business. So the business gives us the money and we give the business the stuff. Or you really would probably say the materials, but we're really trying to keep it nice and simple. So inside of the market, so if I was to say I went and bought a house, right? That means I went to the market and cut down some trees. They gave me money for cutting down the trees. The business then takes the trees, the lumber, and then they build the house. So the business takes the lumber and they provide a service. A product or a service, right? It could be either or. And then for providing that service, the business receives the money. And so you can see that we are tied to each other. So when you talk about things like inflation, all we're really saying is something happened along the way that increases the price of the items. So that could be right here where the market, I make more from the market. So if you charge me more, then that means that you have a higher cost for the stuff. And if you have a higher cost for the stuff, then you're obviously going to charge a higher cost for the service, right? I don't think that is a shock to anyone. And then also what will happen is, and then this is when you talk about government spending and tariffs and all this other stuff, if you insert the government I'm someone who believes that the government benefits from having a balanced budget, from securing our national security interests, and just defending us from intellectual cybersecurity, things like that. Like, I think that that's basically what the government should do, and that it should not be in the business of choosing winners and losers, that people should not be afraid of their government, as we find is often the case. That you find that a lot of businesses make decisions based on whether the government will be happy with what they do, and it has been that way for decades, and it's really unfortunate. But when you insert the government, it then shifts the way that this cycle works. So we could say the government, for example, you might say, well, Dre, how does a tariff impact? And I'll say, I'm glad you asked that. So what will generally happen is if you are, let's say China, because that's the one in the news the most, let's say that an American worker, that I would have paid an American worker 40K a year. And then I could pay a Chinese worker, let's say 20K a year. Well, what happens is if I'm someone that's receiving 20,000 versus 40,000, then the market is half the price. And that's basically what ends up happening. So when the stuff comes to the business and the business provides that stuff to the market, if you have one that's at half the price, then you'll probably buy that one. That's just how we generally are when it comes to economics. We're going to get what we feel is the best bargain, and the business is going to generate what it feels is the best profit. And that's just our interaction in the market. So the government shows up and says, I'm going to add a tariff to you. So yes, you were able to receive that item at $20,000. That's what you received. But now I'm going to add another, let's say just a 20K tariff right here, right? So we're just saying, bam, bam, 20K tariff is added. So what ends up happening? Well, now you go to the market with your new higher price. And so now your stuff is more expensive. Well, who is the one that ultimately pays for that more stuff? You're right. It would obviously be you as the individual. So you pay for it. And that's high level what a tariff does. If I increase that, another way that the government might interfere is the government will provide extra incentives. So you could find this in like our corn industry. So the government incentivizes corn to be made, and that's why when you look in the market, there's corn all over the place. There's corn in your chips, there's corn in your soda, high fructose corn syrup, there's corn in your ethanol, like your gasoline. There is corn in so much stuff because the government pays someone to make corn. And so that's the other way that the government might interact. And so this is what the United States and China, different countries do as well, where they say, hey, I'm not interested quite in a tariff, but what I will do is I will subsidize the business. So the American company, let's say it's $40,000 to get the corn. So then the government says, all right, what I will do is I will pay you 25K to produce the corn. And then the same thing happens. I should probably change the color, but it's too late now. And so then we have the same thing. Now we go to the market. What happens? Well, my cost is lower because the government is paying me $25,000 just to produce corn, which is why we have corn all over the place, because the government is paying companies so much that it's like I'm generating a profit just by having corn, that I only have to really sell it to anyone to make money because the government is paying me to make it. And so now we'll say the United States companies are more competitive in the global market, where they are now able to offer an item that is a little bit lower price because the government has paid them in a way that has removed the difficulty of paying an American employee. And in many ways, that's why a lot of businesses, understanding this cycle, that is part of the reason that they do go to markets and they pay other country laborers to produce the item. And I mean, high level, you'll understand also that's why people who sneak into the United States, why they do have jobs, because the business is the one paying them for that, because they know when people go to the market, they're going to buy the lowest priced item, generally speaking, the lowest price item that provides the most value. And so it's competitive for these businesses. So when you look at this chart, the question ultimately becomes, then where do I put my money to shield it from inflation? Because you can see that a lot of the things that cause inflation. So for example, and I'll change the color for you to be able to see this, where let's say that there was a fire and half of the world's lumber supply is now gone. If half the world's lumber supply is now gone, then I'm going to be paying more in the market because it is now a scarce resource. It is something that everyone is bidding for. So I can't just walk out there and buy lumber for the price I've always been able to buy lumber. And so because the price of lumber now is higher because there's not as much available, and we're sort of dealing with that right now with the price of eggs. because they're going around talking about the bird flu. And a lot of the time, the governments are showing up and they're just slaughtering the chickens. They're slaughtering hundreds of thousands of chickens. So that is going to create a shortage of eggs. They said that they're trying to limit the bird flu, which ultimately means that a great place to shield my money from inflation are places that can increase their price when inflationary periods are happening. So if I'm investing in businesses that can increase their price, these businesses could be investing in real estate. You and I know that real estate, the price of these assets goes up, that the price of my home will go up. So if I'm investing in real estate, then I'm going to be increasing the value of my home with inflation, which means that my assets that I'm investing in, my retirement savings, they're going to be increasing as well. We know that we could also be investing in different stocks because we're taking ownership in these companies. If I'm investing in a company that is able to increase its price in times of inflation, that means that they're increasing their return, and I'm going to be increasing the value of my retirement savings as well. We could also be looking at investing in different things like commodities and gold. And the reason that we lean towards commodities and gold is because what we're basically saying is the government is printing too much money. And if your government is printing too much money, then that naturally decreases the value of your money because there's an abundance of it. And then you'll say, all right, if the government is printing too much money and that's increasing the value of that, then normally that means things like gold, silver, other jewels and gems, they're still a scarce item, that there's more money being printed than gold being undug, that there's more money being printed than there is silver being found in mines, that there's more money being printed than oil being drilled in a well. And so when you look at that relationship where something that is scarcer is more valuable and something that is abundant is less valuable. And you and I would probably agree with that high level that if we walked into a store and there was 100 of the item, we would inherently think it must not be that important. It's going to be here all the time. If I don't make a decision today on whether I want it, then I can come back next week because it's still going to be here. There's so many of that item that even on a psychological level, we just inherently think something must be less valuable. While when you look at real estate, especially now because interest rates are a little bit higher, no one is selling their home. So that ends up shrinking the supply, where a lot of people are saying, well, the interest rate I have now is 3.5%. And if I sold my home, my new interest rate would be 7%. So I'm just going to stay in my house. Because so many people make that decision where there's just really people only moving if they feel they genuinely have to move. Now people are bidding for a scarcer resource. So you've seen it where people are paying $100,000, $200,000 over asking price because there's not that many homes available. And so we can see that relationship, that economic principle on display all the time. And so for a lot of us, if we're investing in real estate, stocks, gold, you guys know I'm big on investing in the business. You could reinvest in your own business. And you can also invest in something called TIPS, which is Treasury Inflation Protected Securities. And all that is it's just government debt. I mean, if they're printing a whole bunch of money, then you could technically buy the debt that they're printing all the money with. And what the government is essentially telling you is I promise to increase how much I pay you back based on how much inflation goes up. And so if you're dealing with times of high inflation, you either need to have an asset that is already inflation protection tied to inflation. So that could easily be like someone's pension, older pensions. It's not as common as much anymore. But if you have an older pension that's tied to COLA, cost of living adjustment, then you don't really have to worry as much from your pensions perspective. If you can invest in inflation adjusting debt like TIPS with the government, then again, you at least know that you have a return that's going to keep up with inflation. And then, as we just mentioned, all those other asset classes that increase in value during times of inflation, either because they're a scarce resource, so they're more valuable, or because that asset class generally can increase its prices, then that also gives us the ability to grow in times of inflation instead of only paying a cost out. It's important to always mention that you should still maintain what we would consider a balanced portfolio. And so you don't want to just say, all right, well, if inflation is happening, I'm not sure what the government is going to do. I'm just going to invest all of my money in that. I would say no, that we still have to have a balanced approach. And so the way that we normally do that is we normally diversify based on the risk that we believe we're going to have, where we have a percentage of our investments that might be invested in the stock market. And what I might say is you have a percentage of your investments invested in something that we would consider aggressive. Aggressive for me simply means that it's possible for my investment to go to $0. And so the stock market can technically go to $0. Your business can technically go to $0. and real estate can technically go to $0. But what you will see is if we're able to invest in not only that, but we're able to adjust our investments in a way where I have something that is safe, and then your asset allocation mix depends on things like your time horizon, which is a fancy way of saying how soon do I need my money, is also based on your risk tolerance and your overall lifestyle that you're going to have in retirement. All of this goes into consideration when deciding where should I put my money. And so then we have a percentage of our money that we would consider safe and stable, but we do want to make sure that we're at least still keeping up with inflation. So that could be where you would have the dead. So that could be the tips, right? We can have the tips there, and then we can keep an eye on that. And then we would just continue allocating our assets. And so you could be someone that said, well, I do like gold a little bit more. And if you're someone that likes gold a little bit more, God bless you. You can have a percentage of your assets invested towards gold. And then the last thing that we normally would consider is maybe some tax advantage accounts. So we know that during times of inflation, that another way that we can mitigate inflation is to increase our return. But that doesn't mean that we have to always take on more risk. We don't have to invest more aggressively. We could just invest more strategically. And so we could be saying, all right, well, if there's a tax advantage account, let me clear that up. It's starting to get a little messy over here. And so when you start talking about investing in tax advantage accounts, we could be looking at a Roth. If I'm able to decrease how much I pay in taxes, that increases how much money I have, and it also increases how much money I can spend. We could also take a look at things like a health savings account. We talk about that all the time, where it has the triple tax benefit. So the Roth, I put the money in after I paid the taxes, so I've already paid my taxes on it. And then it grows tax deferred, so I don't pay taxes on the growth, and then I can take the money out tax free. And so I have that benefit inside of a Roth. I pay taxes once in the beginning, and I get tax free money in retirement. The health savings account is called the triple tax benefit by most people. And that means the money actually goes in tax deductible, which is kind of cool. That means the money went in without me having to pay taxes on it just yet. And then the money also grows tax deferred. So I haven't paid taxes on the growth as well. As long as you take the money out for your healthcare expenses, which is going to be something that all of us will have, then that means I get to take the money out tax free as well. As a result, because I'm being mindful of my taxes, I have now increased how much money I have and what my overall returns are, which is another way that can help me overcome inflation as well. And when we talk about your health savings account, that segues nicely into rising healthcare costs. When we talk about inflation, all we're really saying is the cost of your lifestyle goes up. Well, nothing goes up quite as fast as your healthcare expenses. And we know the studies show that we're going to spend about $150,000 as an individual, about $350,000 as a couple over the life of our retirement on healthcare expenses. But that number is going up higher than inflation. If inflation is 3%, then your healthcare expenses are maybe 6 to 8%. That we see our healthcare goes up a lot over the time. And when you look back at this chart, I can pretty much show you exactly why that happens. And you can see, because what ends up happening is you go to the market and the service is your doctor. So what we normally do is we'll go to the market and we'll go see our doctor. So they're going to provide a service to us, take our x-ray, check our eye vision, things like that. We pay the doctor the money. This money is normally going to be your deductible or something like that. And then for receiving the service, they get the money, they give us the service. Well, the doctor's office, right? So this is our doctor. Not all of them, of course, but what many of them end up doing is they end up billing the insurance company. And so the insurance company then sees what the bill is. And a lot of the time, because we don't know how much the doctor office is actually charging our insurance company, many times what they do is they charge a lot of money. But the average person is not concerned with how much their insurance is being billed because they only had to pay whatever their deductible was. But when you get billed here, what ends up happening, because we're all connected, what does the insurance company end up doing? Well, the insurance company is going to show back up over here and charge us what we pay every single month, right? Whatever that premium is that you pay every single month, your premium goes up every single year at your job. Your premium goes up because what ends up happening is the insurance company, and don't get me wrong, I understand the insurance company literally makes billions of dollars. Like, I get that. We're just talking about high level, the economics of it. And so if they are charged 3 times the amount and then you and I only paid 1 times the amount, the insurance company is going to then show up next year and our premium is going to have that amount added on to it. They said, hey, we only charged you 1 time the amount. You went back to the doctor and the doctor charged us 3 times the amount. So we're going to charge you at least the 2 to break even. And then you and I know that most likely the insurance company is going to add a little bit. So they end up charging you 4 times the amount. And then we go through that cycle again. The reality is, for most of us, the market would adjust if you and I actually were interested in how much the doctor was charging the insurance company. That if it was a little bit more transparent, where we were just aware of what that cost is. And I say that because I remember when I didn't have health insurance and I had to get knee surgery. And I remember going to the hospital and they told me, hey, your knee surgery will be like $40,000. And then I told them, I was like, well, I'm actually going to be a cash patient. And she has this big old book. It's like a big spiral with laminated pages. And then she like flips through 50 pages to get to the cash payment section. And then she looked through it and she said, okay, your knee surgery will be $4,000. And I remember kind of looking around like, did anyone else see that? Did anyone else just experience what happened? When they thought I was paying with insurance, they said it'll be $40,000. When they found out I was paying with cash and I was their customer, they told me it was $4,000. And I had the same surgery with the same doctor, the same event, the same day. It was just completely different price for if you have your insurance cover it versus if you pay cash. And I had that experience happen multiple times where I remember I went to get my x-rays for the knee surgery and they said the MRI machine, that's going to be $4,000. And I said, well, I'm a cash patient. And then the woman took a piece of paper out and she wrote an address on it. And she said, go to this address. They will do the MRI and they'll only charge you $400. And then they'll give you a disc and that disc will have all of your scans on it. Bring us the disc back. And again, I'm sitting here looking like, does anyone else see what is happening? That if you tell them you're a cash patient, that the price is 1/10 of what they're charging if you tell them that you have insurance. And you and I know that based on how good your insurance is in a lot of times how much they subscribe to you, that they'll run up your bill because they're like, you have great insurance, they're going to pay for all of this. What's the big deal? You don't have to pay anything extra. But the truth is you do. That everything is connected, that the cost always comes back. And I know my whiteboard is starting to get a little crazy, so please forgive me on that. I'll try not to draw anything else on the whiteboard today. In addition to ensuring that your normal healthcare is covered, then we have to consider things like our out-of-pocket for Medicare, that Medicare doesn't cover everything, that we have out-of-pocket expenses, we have co-insurances, and we need to be looking at what those costs will be as well. We also have long-term care, where 7 out of 10 people, 65 and older, will have at least one long-term care episode. And on average, that tends to be somewhere around $150,000 over the life of someone's retirement. It's about $50,000 a year on average. 3 years is how long long-term care is. And so when you look at these healthcare expenses, because healthcare and college, they go up so much, that ends up costing us a lot more. And so we need to be mindful of these healthcare expenses, whether I do preventative things like walking and meditation and being outside and trying to adjust my eating habits, where I can prevent a lot of these things. But sometimes things just happen. And so we do want to be planning ahead of time where I might be investing and saving more for my retirement to make sure that my healthcare expenses are covered. That my lifestyle right now is based on me being healthy and my employer paying a part of my health insurance. But when Medicare is the one paying for some of it and I have to pay other expenses, there is an adjustment in my healthcare expenses that generally as we get older, we have more nicks and dings that we have to be thinking about. And if that is happening, then I need to have more money that's set aside to cover that healthcare expense so that I can make sure I have the same quality of life that would help me enjoy my retirement overall. And we'll finish up today's discussion on how to shield your retirement savings from inflation by just talking about your overall withdrawal strategy. And when you talk about your withdrawal strategy, the main thing that we want to be thinking about and ensuring is that we're keeping up with inflation as our lifestyle. And so there's a couple things that we normally would be thinking about. The first one is probably the 4% withdrawal strategy. That's what most people are going to take advantage of. And all we're saying here is that I have $1 million in my investment account. I'm going to take out 4% every single year. So that means that I will take out $40,000 from my withdrawal strategies. It's important to periodically increase that 4%. That you either once every 5 years take a look at it and you just simply adjust your lifestyle. So how much have my costs went up? How much money do I need to maintain that? And then if that is 4.5%, then 4.5% is what we increase it to. If that number is 5%, then 5% is what we increase that to. We probably want to have some sort of a cap. We don't want to increase it too much but we do want to be mindful of the fact that our costs are going up. And so our income should be going up as well. Other people will say, I will actually increase my withdrawal strategy by 3% every single year. And so then the next year, instead of me taking out $40,000, I'll actually take out $41,200. And so if inflation is 3%, then I'm able to maintain my exact same lifestyle. All the things that I bought in my first year, that is the amount that it would cost in my second year. And then I'm able to maintain my lifestyle. The other way that people like to do is the three bucket strategy. And the three bucket strategy is nice because it gives you the ability to stay relatively aggressive and keep up with inflation without having too much of a risk on your investments. So what we'll normally do is we normally have bucket number one, right? Bucket number two, bucket number three. And so this is going to be my conservative bucket. This is going to be my moderate bucket. And then this will be my aggressive bucket. And the idea of my aggressive investments is I normally need a longer time horizon. That's why a lot of times as we get close to retirement, we start limiting the risk. Well, what if we are able to maintain a percentage of our allocations that are able to be aggressive, that I'm still not going to touch that money for a period of 5 years plus? And so we would say probably at a minimum 5 years, but I would probably even consider it maybe being like 7 years. But anywhere from like 5 to 10 plus years is where this bucket is going to be. And then everything that is aggressive, so it would be those same things that we mentioned. That would be your business, that would be stocks, and that would be real estate. So we're able to maintain our aggressive investments. We don't have to get rid of everything. Bucket number two would be our moderate investments. So these are normally going to be things like bonds, which is government debt, as we mentioned. It's going to be dividend paying stocks. We probably have balanced mutual funds in here, which is 50% stocks and 50% debt and other bonds. Then they probably have any sort of an annuity or your pension from your employer. So these are going to be normally things in your moderate bucket. So this is going to be 2 to 7 years is going to be the time horizon. Things that I have the time that if something unexpected happens, but I'm probably a little bit safer than just really being super aggressive. And I'm mitigating some of my risk. But again, I'm probably keeping up with inflation in this bucket as well. And then our first bucket is normally going to be our most safest investments, and that is going to be cash and what we call cash equivalents. So that could be like a money market account. It could be a CD, normally going to be a year under, but are going to be any short-term treasuries. And so normally, if you have yourself with a three bucket strategy, that then gives you the ability to leave some of your money that's outpacing inflation, some of your money that is not, because now I have spread out the time horizon on each of my investments. So I have my very safe investments, things that I will be using in 1 to 2 years, but then I have my modern investments, things that are going to be a little bit more than that, maybe 3 to 5 years. And then I have my aggressive bucket still maintaining my 7-year, 5-year plus time horizon. And the reason I like the three bucket strategy is because the main reason we are more conservative with your investments as we get closer to retirement is because we know that while the stock market does tend to go up over time, that there are recessions, that there are drops in the market, that there are dips in the market, and there's generally one every 10 years. So if there is a recession once every 10 years, then that normally means that I have to be more conservative in my investments because I don't have that time horizon to make back my losses. I am now withdrawing money from all of my investment accounts. But if you leave a portion of your investment accounts that's still not going to be touched for 10 years, you give yourself the ability to still ride those waves that, yes, your aggressive bucket is still going to have that hit once every 10 years, but you have your safe and moderate areas that are not going to be hit at all or a very limited amount. And so that's one of the reasons I do like that as well. So if you're trying to keep up with inflation, then we have to keep a portion of our investment that is focused on growth of outpacing inflation, even though we're still able to limit a portion of your investment to where you get to take the money out and enjoy yourself in your retirement overall. As you can see, protecting your retirement requires planning ahead of time. Inflation is inevitable. So by getting ahead of this and putting the strategies in place that ensure you can maintain your peace of mind and comfort in retirement will go a long way to enrich your retirement and ensuring that you get to live that lifestyle that you had always dreamed of. If there is anything I could do for you, if you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.